Hi there, Pragati here. Today I want to share with you general things about investing, how you should start investing, why you should start early. A lot of people, one of their biggest dream or your biggest goal would be to own their first property, to own their home. Okay, so you'd work hard, you'd get the deposit for your first home, and you get the first home, and a lot of people may just get stuck there. Okay, so I got my first home, now I want to pay the mortgages until the property is mortgage free. I'm not sure if that's a good plan at all, because what you should do is you should start investing in different things. Okay, so when you were in the university, like when I was in the university, for example, I invested some money in small money, 200-300, a couple of pounds, into the forex market, into the stock market. And when you do that, what happens? You actually learn the concept of investing. So you might lose some money because you haven't got so much knowledge and skills. So you are actually learning by making little mistakes, which is perfectly fine, because the mistakes that you make early on in your life are less costly. That will kind of teach you the basics of investing and how things work, which could play a bigger part in just modeling your life as you move forward. So let's just think about, let's say you're not investing, okay? So you got the money coming in, but you're not doing anything with the money. What's going to happen? So you got that money sitting, in a savings account. The interest rate in the saving account right now it's about 1%. Okay, the inflation is about more than 1%, it's about 1.5%. So if you leave the money sitting in the savings account, you're not going to get anything. The value of your money in 10 years' time is going to be less than that. Okay, so your £10,000 sitting in there now will be less than £10,000 in 10 years' time. So you've got to do something with that money so that you beat the inflation. The return you should aim to get on that £10,000, whatever amount it might be, should be higher than the rate of the inflation. Okay, so that's very, very simple and very important. You might be asking, what investments are there that will give me higher interest than the inflation? There are loads. Some of the choices of investments that are in the market that are easily accessible are your stock market. There are lots of platforms, online platforms as well, where you can invest. You can also go to the bank and speak to the investment manager. They will put your account into some sort of investment funds in there where there might be slightly higher return. You can do that. You can also buy shares in the companies. You can buy government bonds and gilts. You could be putting money in peer-to-peer lending platforms, that is getting quite popular as well. You got that. If you've got a slightly larger amount of money, then for sure put into another property, into a buy-to-let property. That's a great investment form of investment. Now when it comes to the stock market and in a property, there's always a big debate on which one is better. And stock market and property generally give you similar return, about 8 to 10% return maybe in an average. But then, the beauty about the property is that, you can lend money to buy a property from the banks. Okay, so that's the beauty about the property, whereas you cannot lend money from the bank to buy stocks or shares. You cannot. And the other thing about the property is the value of the property goes up over time, as well as you get rental income. Okay, so you've got two forms of income from the property. That's why my personal preference is property. But like I said, property does require a slightly higher investment. You're looking at least £20,000 to start with. Okay, so yeah, these are some of the things that I think you should do. Start investing early and don't be afraid to make mistakes. That doesn't mean that we should put all our money into investment, because you need to have some sort of reserve or emergency fund in your account. How much of the reserve fund you need, of course, that depends on your daily expenses, necessary expenses. Think about what we're going through right now, the coronavirus situation. At least 3 months, a lot of countries are into lockdown. Okay, so even if you double that, make it into 6 months. Okay, so then you're ready for a worst case scenario. So have reserved for at least 6 months that you can use to move on with your daily life. And one of the other thing that we must do is to invest in yourself. Okay, so what that means is you've got to put some money aside every month. It could be 10% of your earnings every month, which you're going to put aside, on which you're going to use it on yourself. What that means is to acquire new skills, to acquire new knowledge, and to progress yourself, to make yourself better every day. So you're going to use that money. It could be to buy books. It could be to find a mentor that you're going to connect with. It could be going to trainings and seminars and things like that. Okay, so put some money to invest in yourself. Okay, the other thing that you want to do with the investment is always diversify your investment. So you don't want to put all your eggs in the same basket. Okay, because if anything happens, you're going to lose everything. Okay, so same thing with the investment. Okay, so if you've got £50,000 with you, you don't want to put 50,000 into one house only. Okay, so of course you want your own residential property to be nice, where you might spend a little bit more, but then once you're done with that, the other money, just try and diversify the money. Okay, so maybe you could have 50% of the money you've got into the sector that you're very comfortable with, that and you're in control of. Maybe 30% could be into another sector, and then you've got another 20% somewhere else, then you've got another 10% somewhere else. So you sort of diversify the portfolio. Okay, so the larger chunk being in the area that you're more expert, that you're more knowledgeable at, and the other ones in other areas, just in case something went wrong. For example, think about this. A lot of hospitality businesses during this lockdown, there's zero sales, nothing's happening. Okay, so if you was just using the money to just to buy restaurants only, for example, okay, so you've got 10 restaurants, for example, okay, and they are quite costly to maintain, and if there was a lockdown like this for another 5 months, it's going to be very difficult. When you're in the business of investing, you need to understand how the market reacts to certain things, like how did the market react when there was a global pandemic? How does the market react if there was a terrorist attack somewhere? Yeah, so you need to understand just basic things like that, and not to panic. That's so important, because this is where a lot of people, they lose money, because they suddenly react to a particular situation. Okay, and then they might make a decision which probably wasn't right. Okay, so do not panic, because the market goes up and down, and then if there was anything sudden like this, and again it will recover. As long as you've got funds enough to maintain that while the recovery is happening, you should be okay. So do not panic. Okay, so the other thing there, when it comes to investing, and the simple thing which a lot of people know, is high risk, high return. So it's important to understand the less risky investment tools from more risky investments. Okay, so and what risks are there? The less risky ones, of course, are your bank saving accounts, and you've got the government bonds and gilts, where you're lending the money to the government, or maybe more blue chip companies. That's the bond, and you get a certain interest on that one. So if they are blue chip companies, pretty stable, but the returns are also sort of mid to low level, but definitely inflation beating returns, 100%. And then you've got a bit more risky investments, such as the share market, or maybe some new company has just come up, and you're putting the share on that one. That could be quite risky, but then the returns could be high as well. So you just need to understand a few basic things there. There are certain types of companies, such as the renewable sources of energy, which is heavily government backed, so you've got the support of the government there, so returns of 8 to 10% is pretty normal on that one. Okay, so these are only some of the ones that I can just remember top of my head, but if you do a little bit of research, you will find quite a lot of them. And where you want to invest, it depends on the level of confidence level of understanding of that particular sector for you. You could be, if you wanted to do a passive investment in property, there are lots of property funds, where you're not directly investing into buying one property, but you're investing into a fund. So you could do that. The return from your investment can be in two forms. It could be like a monthly income or a quarterly, or it could be at the end. So there are some investments where you put the money in there and then they will give you a quarterly return, maybe, but then the return could be slightly lower than if you were actually investing for the whole term. If the investment was a 2-year term, then getting the whole investment at the end will give you a higher return than if you were getting every quarter or every year. When you talk about investments, often we come across short-term, mid-term and long-term investments. So a short-term investment could be up to 3 years, maybe 1 to 3 years sort of thing. A mid-term, it depends person to person generally. So mid-term investment could be 3 to 5 years. A long-term, I think nowadays a long-term is very hard to think long-term, because the world is becoming so uncertain around us. Having a very long-term plan, you could be losing out on a lot of things. So if you was planning to have a big holiday after 10 years, you don't know what's going to happen in 10 years time, because we didn't know what was going to happen next month when we were in February. Thank you for watching. If you like my video, please like and subscribe.